Welcome everybody to this week's edition of Reverse Mortgage Weekly, where we go over the reverse mortgage program and basically try to educate folks the best we can on this wonderful program that's changing people's lives every day. Thanks for tuning in. We try to do a presentation every week, or we've been getting into basically having folks. Uh, do a quick interview so that we can introduce you to more services that for people that work with seniors. So once again, my name is Zach Smith. I'll be your host today. I own Chariot Financial. Let me go ahead and change my view here so that you can see the screen a little bit better. Now, I'm wondering if this is, I'm going to go ahead and just, we're having a little bit of technical difficulties here, but that's not a problem. We are trained professionals. We know how to handle these situations here with grace and the best way that we can. So here we go. Oh, there we are. There's me. My name is Zach Smith. I own Chariot Financial. I've been in mortgage and real estate for 21 years. Can you believe it? Okay, not quite 21 years. It'll be 21 years in May of this year. So we're about a month away from 21 years. So 20 years and 11 months if we want to get technical about it. So again, I own Chariot Financial. We're a small boutique mortgage broker firm here in Colorado. We specialize in the reverse mortgage program. I've been a CSA or Certified Senior Advisor for about 8 years now. A wonderful program that's designed to help understand and really serve older adults in the best possible way that we can. So let's get right into the presentation here. So what are we going to go over in this presentation? Well, first thing we're going to do is go over who typical clients are that we see for the reverse mortgage. We're going to go over what a reverse mortgage is, what a reverse mortgage is not, and why people are choosing a reverse mortgage right now. Very popular program. And how do they work in simple terms? So just going forward with the presentation here. In fact, I'm just going to change my little view here. So just having fun today. We're just having fun with our technology. So who are typical clients that we see today for the reverse mortgage? Well, the number one client that we usually see are older adults that are looking to increase cash flow. Cash flow becomes a pretty tough situation for folks in retirement, mainly because we're not working as much as we were previously at our job, or we're just not working as much, or maybe we don't want to work as much. Maybe we want to take some time off and start kind of winding things down a little bit. So cash flow can become vitally important in retirement. And so by the way the reverse mortgage works, it helps people access their equity or convert a current mortgage payment into a payment optional program. And it's my assertion that if you're 62 or over, you should not be making a mortgage payment any longer. And the reason that I say that is that if you are making a mortgage payment after 62, you're taking it from one of two buckets. The first bucket that you may take it from is your cash flow, meaning your retirement funds, your pension funds, or your part-time job, whatever cash flow you have coming in, that's what you would be taking those funds from. So in retirement, sometimes that bucket can be smaller than it was during the times when we were in our youth, when we were working more. So to be able to create a situation where you're not having to take out of that bucket, out of that cash flow each month, is quite advantageous for folks. So that's one reason, that one bucket that you'd be taking it out of if you're paying a mortgage payment. The other bucket that you'd be taking it out of is your nest egg. And your nest egg becomes vitally important in retirement because we don't know how long we're going to need it. You could live to 70, you could live to 80, you could live to 90, you could live to 100. We just don't know. So to do financial planning from age 70 to age 30, I mean, that's a gap of 30 years that you would need to plan for. So to keep your nest egg solvent over time is vitally important for our financial well-being when it comes to retirement. So if you're paying a mortgage payment, you're either taking it from bucket number one, which is your cash flow, which is, again, sometimes not as much as it was during our years that we were working more, or you're taking it from your nest egg, your crown jewel that you want to try to keep solvent for the rest of your life. So taking a mortgage payment from one of those two buckets is just not a great idea, in my opinion. Now, if you got a big pension coming in, you've got a, you got a, $5,000 pension coming in every month, and to 2,500 and Social Security, then you're probably not in a bad cash flow spot, and you probably could make sure that you pay that mortgage and pay that off or whatnot. So that may not be a big issue. But if you're short on cash flow, a lot of times a reverse mortgage is going to be a great option, because not everybody has a pension and not everybody is able to make it on Social Security alone. Not to mention that even if you are paying a mortgage payment, the 30-year fixed mortgage has really got the deck stacked against the consumer. You pay 50% of the interest on a 30-year note in the first 10 years. So even though you are making a mortgage payment, you're doing everything right, and basically a lot of that mortgage payment that you're paying each month is going right to the bank in interest because of the way the amortization schedule works. I'll give you an example. If you have a $600,000 loan amount at 6.125%, your principal and interest payment is going to be somewhere around $3,600. Well, that first payment, only $600 of that is going to pay off the mortgage. The other $3,000 is going right to the bank in interest. So another reason why you may or may want to reconsider paying a mortgage in retirement. One, because of the buckets you have to take it from, and two, just because a lot of what you're paying in the beginning is just going right to interest. The second group of folks that we see with the reverse mortgage product in retirement are folks who need relief from high monthly payments, like debts like a mortgage, credit card payments, car payments, medical bills. The list goes on and on and on of some of the expenses that older adults see themselves having to pay, especially when you start talking about medical things, or if you need in-home care. Medicare doesn't cover everything for that. And we have in fact, we might do our whole presentation on home health care next week for just to kind of give you insight on what the reverse mortgage can do to help with getting services that are really desperately needed by many that may have to come out of pocket. Well, if you are not able to come out of pocket, what do you do? Well, the reverse mortgage is a great option for folks in that situation because it can give you access to that equity. Again, equity is like having a glass coffee table right there in the middle of your living room full of cash that you can't get to. It's not like you can take a picture of your house and go to the gas station and pay for your gas with it. Equity is great to have, but it's not liquid. And that's really the issue that a lot of people find themselves in retirement, is they're equity rich and cash poor. But this is not a program of last resort that a lot of people think it is. Can it be used as a program for last resort? Let's say you are in that situation where you're equity rich and cash poor. Yes, you can use it to flip that situation so that you become more cash solvent and not rely so much on your fixed income for expenses. You can basically build some expenses into your equity, which is a great advantage of owning property. But it's not, so it does work out in that situation, but it's not a loan of last resort that a lot of folks will lead on to make you think that way. It's also a great financial planning tool for folks who have large assets in the bank, own their home free and clear, all of that stuff. It can be a great asset for them as well. So let's continue on here. So what is a reverse mortgage? It is a mortgage loan, so it's a lien against the property. It does have monthly mortgage payments. That's, a big group got in trouble, a couple years back where they were advertising with their celebrity sponsors. Oh, we're going to eliminate your mortgage payment. Well, that's a little bit misleading. You don't have to make a mortgage payment if you have a reverse mortgage, but there is still a monthly mortgage payment. It's just that payment is optional. So it does have a payment, but it is optional. And generally, the reverse mortgage will come with a line of credit, a cash payout, so that they can pay you cash at closing, or a tenured payment where you basically would convert your home into like an annuity so that it pays you back each month. Now, I'm not saying it is an annuity. I'm just saying it's like an annuity in the sense that it would pay you back each month. So what a reverse mortgage is not. Well, first and foremost, despite what your uncle will tell you, it is not a way to take over your home. I've been so surprised and really a little bit appalled of some of the advice that some of the so-called financial gurus have given about the reverse mortgage product. Very prominent reverse mortgage, a financial guru was talking about the reverse mortgage, and he basically was talking about how someone didn't pay their taxes on their property and the county ended up foreclosing on them. Well, they just so happened to have a reverse mortgage. And the way he ended that was that, the reverse mortgage is a scam. It's just a way to get your house. It couldn't be anywhere further from the truth, especially if you're educated in how banks make money. Banks do not make money off of real estate. They don't want your real estate. In fact, it's a big problem for them. It's just like in 2008 when folks were really in a tough spot. They weren't able to pay their mortgage. The housing market, it was in a free fall. And there was a sentiment among people that the bank wanted your house. They just want to take your house. No, they don't want your house. It's a big problem for them if they have real estate. And if you go upside down on the reverse mortgage, guess what? It's a big problem for the bank too. And, the sentiment is, the bank wants your house. They just want you to go upside down. No, if any of those two things happen for the bank lost. It's a bad deal for the bank because it's a non-recourse loan. They can't recoup any of those costs if you go upside down. So they're very cautious about ensuring that you don't go upside down because of that reason. But despite what you hear on TV and what you hear from what we would think are trusted advisors, it's not a way to take your home. It's a way to help people access their equity. And more importantly, it's a way to help people age in place. So it's also it's not a way to make you upside down on your home. Again, that's a bad deal for the bank if you go upside down, because then they're on the hook. They're on the hook for an amount that they can't recoup. That's a bad business deal for the bank. So they don't want you to go upside down. Is it potentially, can you go upside down? Yes, but it takes a really, really long time. And it's not a payment-free mortgage. Again, I can't stress that enough, that there is a monthly payment with the reverse mortgage. It's just optional. Now, 99.9% of my clients who have a reverse mortgage choose not to make that monthly payment because they're thinking, well, this payment, as I explained earlier, most of it is going towards interest right to the bank anyways. Very little of it is going to actually pay off the mortgage. So why not just take that monthly mortgage payment and put it in your pocket? Then you can direct it. Then you can move the money around. But if you wanted to treat the reverse mortgage like any other mortgage and pay it down and make a monthly payment and pay it off, you can certainly do that. So when folks look at this, the balance grew over time, they went upside down on the reverse mortgage. Well, really, that is a choice. They give you an option to make a payment every single month. However, that payment is optional. So just keep that in mind, because there's a sentiment out there that, thinks that, the government's trying to take over your house. They want to make you upside down. Those are two horrible things for the government, horrible things for the bank. They do not want that. Um, and again, it's not a payment-free mortgage at all as well. So why are people choosing to take these out in retirement? Well, it's really simple in my assessment. Really the main reason is liquidity. People need to get access to that equity. Again, the equity is like having a glass coffee table right there in the middle of your living room, full of cash that you can't get to. And secondly, long-term financial planning. This is a great long-term financial program that can set people up for a much higher standard of living in retirement. So let's talk a little bit about home equity and liquidity. So, equity is great to have, but unfortunately, it is not liquid. Again, it's a lot like having that glass coffee table right in the middle of your living room full of cash that you can't get to. So you're sitting on your couch, you kick your feet up on your glass coffee table full of cash, and you're thinking to yourself, oh my gosh, it's great to have that cash there, isn't it? Well, something happens, you need to fix the car, or you got a medical bill, or you need cash. You try to get into that cash in your living room and you can't get to it. It's locked up in the property. The only way to get to it is to take a loan out or to sell the property. Well, if you sell the property, then that begs the question of where do you go? That's another thing that's kind of a bird in my saddle when a lot of these financial gurus, so to speak, talk about the reverse mortgage and they say, it's a bad idea. Don't do it. Don't do it. What their advice is to sell your property and then rent. I think that's the worst advice ever. For me, for probably everyone looking on this video right now, housing is probably the largest expense that we have. So if you can eliminate that expense, or at least convert that expense so that you're not paying it out of pocket in retirement, what a huge benefit. And that's exactly what the reverse mortgage does. I tell this story almost every class because I think it really illustrates how the reverse mortgage works. So I spoke with somebody the other day, and of course, she's heard all the news about how the reverse mortgage is a bad deal. It's expensive. You go upside down on your property. And she said, I don't like those reverse mortgages because my girlfriend had one. And when she sold her parents' house, she only got $7,000 back. So the first question I asked, well, how many payments did they skip? And she kind of didn't really know how to answer that because they had it for 20 years. And had they had that mortgage on the property and they would have made monthly payments every single month, they would have paid about $280,000 over 20 years. So then you have to ask the question, who was going to come up with that $280,000 over the last 20 years? Was it the parents? Did the parents have to come up with that? What quality of life would they have had if they were struggling on a fixed income in retirement, trying to crack that nut every single month so that they could make that monthly payment? That would not be there's countless of Americans in that situation right now that are struggling, sitting at the kitchen table. And, when you were younger, you could get up, okay, well, maybe I can get a side job. Maybe I can do this. Maybe I can do that. Maybe I can generate some more income. Well, when you're in your 70s and 80s, it's a lot tougher to do that. But you don't want to leave your home. You want to age in place. And that's really what this program is designed to do. So that $280,000 had to be paid from somebody. If it was paid by the parents, maybe their quality of life wouldn't be that great over the years. But the bigger question that I would ask folks who have aging parents is, just like Forbes, they had an article last few years or a couple of years back that talked about how our parents could be our biggest financial risk. And mainly it's because we haven't quite figured out how to get affordable health care for everybody. So healthcare is still the largest cost out of any cost in retirement. It's still the number one reason why people go bankrupt. So if something like that were to come up and they didn't have access to any of the equity, Well, the daughter may have had to come out of pocket, or at least out of pocket, to pay a portion of that $280,000 over the 20 years that they had their reverse mortgage. So that's the one thing that isn't talked about. It's talked about, oh, the balance grew and they only got $7,000 back at closing. Well, they also didn't have to pay $280,000 over the past 20 years. So it's one of those things where the reverse mortgage, it's a lot like taking a nickel out of your left pocket and putting a dime in your right. But no one ever wants to talk about the dime. They don't look at it. They don't see it that way, which is the main reason why I'm doing these podcasts. Is I really, truly, in my heart of hearts, you don't have to use us for a reverse mortgage, although you can if you go to chariotreverse.com. That's chariotreverse.com, chariotreverse.com. You don't have to use this for a reverse mortgage, but talk to somebody who's an expert at it and see if it can improve your retirement or improve your parents' retirement. Because ultimately, if you do have a lien against the property, you have to pay interest and you have to pay that loan back, whether it's at closing or whether it's during the course of retirement. You have to pay it back. You borrowed the money, they have a lien against the property, they can foreclose on the home if you don't pay it back. But the big question to ask is, how do you want to pay that back? Do you want to pay it back during the course, or do you want to pay it back at the end? This is the only program that's due the day after you pass away. So, well, actually, it's due technically 12 months after you pass away. But just something to think about in regards to what makes more sense to you and your family, and what makes more sense to financial planning aspects. So again, you can't take a picture of your house and go to the grocery store and hand your picture of your house over to the cashier and pay for your groceries. It just doesn't work that way. Equity is just not liquid. So why does this matter in retirement? Well, most retirees are on a fixed income and have limited cash flow. Most people don't want to work into their 60s and 70s in the workforce. And also, unforeseen medical expenses can liquidate retirement assets prematurely. So the reverse mortgage basically solves the problem of liquidity. That's why there's a space for it. Necessity is the mother of invention. And if you're an older adult, you may not have access to the equity or cash that you need, but you may have a lot of equity. So this basically puts people in the driver's seat so that they can leverage their home for victory in retirement. So the reverse mortgage is designed to help older adults access equity when you need it, either by establishing a line of credit, a cash payout, or converting the existing mortgage payment into an optional reverse mortgage. So a reverse mortgage as a financial planning tool, some Americans are living longer, which creates a lot of concern about running out of money prematurely. The research of Harold Evensky, Sean Pfeiffer, and John Salter of Texas Tech University published an article about the academic acceptance of the reverse mortgage product as it pertains to the survivability rates of one assets when using their home equity in their retirement plan. So by incorporating your home equity into the retirement plan, here's a graph that we have that kind of goes over several studies, not just one, and not just studies that we cherry picked. These are a wide range of studies that show that in every instance, if you use your home equity as part of your financial planning, that is going to help your assets survive. Your survivability rates of your nest egg, of your assets, of what you're going to pass on to your heirs eventually, hopefully, if you don't run out prematurely, goes up exponentially if you use your home equity first. Because generally what happens is that folks and their financial planners generally make decisions to pass away with the least amount or the most equity in their homes. And a lot of times what people will do is they will exhaust their retirement funds and then they sell the house. And then that begs the question again, where do you go? Do you move in with family? Do you go into a facility? If you go into an assisted facility that is full-time care, you're looking at anywhere from $8,000 to $12,000 a month. So, looking at liquidating an entire nest egg over a very short period of time. Assisted living facilities is that case. And some people do a spin down, or they just don't have the assets and they would go into a Medicaid facility. But you have to ask your question, are those the type of facilities that you want to spend the rest and last days of your life in? Most people want to age in place, and all the research shows that if you age in place, you have a much higher quality of life. So there's different types of reverse mortgage loans. We do several different types here at Chariot, but the most popular type that you're going to see is the HECM. So what the heck is a HECM? Well, the HECM is an acronym for Home Equity Conversion Mortgage, and it's FHA's version of the reverse mortgage program and the most common by far. HECM loans are administered by HUD and come with certain protections for the homeowner. These include a non-recourse feature. You're never going to owe more on the property than what it's worth. Bank failure security. If a meteor hits the earth tomorrow and the banks go under, well, you're still going to be able to have protection because HUD will service the loan. And also increase access to funds over time with the line of credit. So you may start off with a line of credit at $20,000 and it may balloon to $90,000. So you have access to more credit as time goes on with the reverse mortgage. Very unique feature. It's almost like having a second savings account attached to your home. Well, we know this fella. This is Tom Selleck and his legendary mustache. And he was quoted as saying, the reverse mortgage loan is just like any other loan. The only difference is how you pay it back. And gosh, old Magnum PI, he couldn't have hit the nail on the head more squarely, because it's just like any other loan. It's a lien against the property. There's a monthly payment that if you don't choose not to pay will accumulate on the loan balance. And at the end, when you move from the property or pass away or go into a facility or say to heck with this, we're going to Costa Rica and spend the rest of our retirement there, that would be basically when the loan would be due. So why is it called a reverse mortgage? Well, the reverse mortgage is still a mortgage, has monthly payments. The payment's optional. If you choose not to make the monthly payment, the balance will grow every month. Taxes and insurance would need to be paid separately. Like in the example where the financial guru is saying it's a bad idea, it's a way to take your house because that person basically lost their home because they didn't pay their taxes. Well, you know what? That could happen with any mortgage. If you don't pay your property taxes, you're going to have problems with the county. You're going to have problems with whatever that tax authority is. Doesn't matter if you have a reverse mortgage, doesn't matter if you have a forward mortgage, or for any case, no mortgage. So for some folks to look at an example like that and say, oh, it was a reverse mortgage problem, it had nothing to do with the reverse mortgage. It was the fact that they didn't pay their taxes. And if you don't pay your taxes, there's going to be trouble. There's two guarantees in life. Two of the biggest myths that I run into with the reverse mortgage is that you'll be upside down on your property within a few years, or that you no longer have title to the home. Both of these couldn't be further from the truth. There's three ways to structure reverse mortgage loans. First way, the most popular, is through a line of credit. Second way is a cash payment. So you basically get cash at closing. And the third way is a tenured payment where you get paid back each month. The amount that you qualify for is determined by age. So it's a lot like life insurance in the sense that they use actuary tables. So a person who is 62 can borrow less than someone who is 82. So that's all we got for you, folks. Thanks for hanging out with us today during our Reverse Mortgage Weekly. Feel free to call us anytime. You can reach me at chariotreverse.com, chariotreverse.com, chariotreverse.com. My name is Zach Smith, and I hope you have a blessed day today. Thank you so much, and have a good one. We'll talk to you later.